Welcome to the Deep Dive. Today, we're taking a closer look at two players in the pharmaceutical space. Catalyst Pharmaceuticals, that's CPRX, and TransMedics Group, TMDX.
Right. We've got a bunch of their financial data from early 2025, things like market cap, revenue, cash flow, liabilities, the key stuff.
Exactly. And our mission, basically, is to sift through these numbers and try to understand what they tell us about each company's health and, well, how they compare.
See what story the data tells, beyond just the raw figures.
Okay, let's start with market capitalization. The total value the market puts on the company. And right away, there's a pretty noticeable gap.
TransMedics is significantly larger by that measure.
Yeah, as of late spring 2025, TransMedics is sitting around $4.2 billion. Catalyst, on the other hand, was closer to $3 billion around April 1st.
That's a fair difference in perceived value at that time.
What's also interesting, though, is looking at Catalyst's market cap earlier in 2025.
Yeah.
We've got these figures. Wow, they really bounced around. Lower in January, then way up in February and April.
Yeah, those are some big swings. Suggests maybe some significant events or news impacting CPRX investor sentiment during that period.
Could be. We don't see quite that volatility for TransMedics in the data points we have here. It seems more stable valuation-wise, at least based on this snapshot.
Right. The higher overall market cap for TransMedics suggests, investors were perhaps betting more on its future potential at that moment.
Okay, but then let's look at revenue per share. How much money comes in for each share of stock? Here, the picture flips, doesn't it?
It does. Catalyst actually shows a higher revenue per share compared to TransMedics.
So smaller company by market cap, but bringing in more revenue relative to its share count. That's kind of a puzzle piece.
It is. It could mean Catalyst has, say, a more concentrated product line that's performing well, or maybe they're just really efficient at generating sales from their current setup. But revenue isn't everything, of course.
Of course, profitability matters. So let's check out EBITDA and operating income. TransMedics has the higher EBITDA, but Catalyst comes out on top with operating income. Okay, what's going on there?
Well, that difference often points to how companies account for things like depreciation and amortization. TransMedics might have larger physical assets or investments depreciating, which lowers operating income relative to EBITDA.
Ah, okay. So Catalyst, with the higher operating income, maybe has lower overhead or fewer of those non-cash charges hitting the bottom line.
That could be part of the story, yeah. Different asset structures, different operational footprints, perhaps.
Got it. Now, what about actual cash? Free cash flow, the money left after running the business and investing in it. Big difference here.
A very clear one. Catalyst is generating positive free cash flow.
Meaning cash is coming in the door, net. But TransMedics shows negative free cash flow. What does that tell you?
Negative free cash flow isn't automatically bad, especially for growth-focused companies. It often means they're investing heavily R&D, maybe expanding sales force, building infrastructure. They're spending cash now, hoping for bigger returns later.
So TransMedics might be in a heavy investment phase.
Potentially, yes. Whereas Catalyst's positive free cash flow suggests more immediate financial flexibility. They're funding operations and investments from current earnings.
Let's quickly touch on the balance sheet. Liabilities, what the companies owe. Catalyst has lower liabilities than TransMedics.
Generally, lower liabilities mean less debt, less financial risk, maybe a more conservative approach financially for Catalyst.
And finally, ownership. Who holds the stock? Both have mostly free float shares, the ones we can trade easily. Catalyst is over 96%, TransMedics around 91%.
Right, so both stocks should be quite liquid, easy to buy and sell. TransMedics has slightly higher closely held shares, like insiders, which might suggest a bit more long-term skin in the game from management or founders, maybe.
Okay, so summing this all up, we have TransMedics, bigger market cap, negative cash flow, higher EBITDA, but lower operating income. Feels like a growth story, maybe?
That's a plausible interpretation based on these numbers, yeah. Investing for future growth.
And then Catalyst. Smaller market cap, but positive cash flow, higher revenue per share, higher operating income, and lower liabilities. Seems more stable or perhaps focused on current profitability.
Exactly. Two pretty distinct profiles emerging just from this financial snapshot. One seems focused on expansion, the other perhaps on efficiency and near-term cash generation.
So for you listening, the question becomes, what do these differences suggest about where these companies are headed? What are the potential risks and rewards tied to each strategy?
And what else would you want to know? Maybe details about their drug pipelines, market competition, management strategy. That's where further digging comes in.
Definitely food for thought. That's all the time we have for this deep dive.